Our bond discussion will be answering a series of questions, and this is one of many videos and lectures on bonds, but this is the introduction. So these are some preliminary topics on bonds. So what is a bond? A bond is a promissory note of a payment. So let's type one, just as an example. So the issuer of this note promises to pay $1,000 to the holder of this note on June 16th, 2020. Well, that's a bond. That's a promissory note. Now, the issuer is the person who is writing the bond, and the holder is the person who is buying the bond. Now, if this is just the holder, then this is referred to as a bearer bond, where anybody who holds the bond has the right to collection of this bond. Now, a lot of the times, bearer bonds are not common. So this will be a registered bond, and it will have a name: to Mr. John Smith on June, as such. Now, the registration will be perhaps not to a specific name, but to your institution who you have a brokerage account with. It will go through the clearinghouse. Whoever is holding the bond will have the registration. But the point is that the bearer bond will have the holder of this note, and it will be just a no name. So let's go through our question. Who issues a bond? Well, anybody can issue a bond. A person can issue a bond, a corporation, an institution, an agency, government, any government, municipality. Obviously, the issue is who will have the credibility to sell a bond. So anybody can issue a bond. However, it is a lot more common for governments to issue bonds since they have the required credibility to sell these bonds. And then you would have agencies, municipalities, corporations, and I think down in the list would be individuals, if any. Who buys a bond? Well, bond is a fixed income security, which means that it's not like a stock where the future earnings are unknown. Bonds have risks, obviously, but it is referred to as fixed income security simply because as long as everything goes as planned, we know how much money we're going to earn by holding a bond. So anybody can buy a bond. Individuals, institutions, agencies, corporations, even governments can buy bonds. Buying a bond is an investment, so anybody who wants to invest can invest in a bond. What is a face value, or also known as par value? Well, on our bond, this $1,000 that we are going to receive at the end of, or on June 16, 2020, that's a year from now, is referred to as the face value. So that's the face value. Now, how is current price of a bond determined? Now, the question is actually very simple. This is $1,000. The holder of this bond will receive this $1,000 1 year from now. How much are you willing to pay for this? And it is you who determines this price. If you are willing to pay $900, well, then that's the price. If you're willing to pay $800, then yeah, that's the price. If you are even willing to pay $999.99, or even $1,000, you know what? Even say $1,010. It is the price of this bond. So the question is how the current price is determined, meaning how do you come up with this price? How do you come up with $900 or $800 or even to have a loss on a bond? Well, it is based on your comparable investment choices. If you have an investment choice of a similar risk that actually is available for you to trade, then whatever the going price for that one will determine the price for this specific bond. You have several choices. You could invest in a stock, you could buy a real estate, you could buy commodities like gold, precious metals, precious stones. You have, a list of investable choices. So what makes you invest in this specific investment is the question, and how much are you willing to pay to get into this to this deal. Now, the supply and demand will also determine the price of a bond. So if everybody wants to buy this bond, it will actually drive the price up. If nobody wants to invest in this bond, nobody wants to buy this bond, then it will lower the price. Why would anybody pay too much, or even more than the face value? Well, Japan and Germany have government bonds that actually have negative yields, which means that people are willing to pay more than the face value. Well, if it is the only way to save your money, and people feel that their money is safer by investing in this bond, then they will simply pay a premium, not to have a profit, but to even to have a loss, in order to own and protect their money in this investment. So what is maturity? Well, the maturity is the time or the date that you're going to receive the face value. It can be as short as a few days. It can be as short as a few years, or it can be as long as 20, 30, 50 years. And the bottom line is, whatever maturity you can sell, or the corporations or the governments can sell. Obviously, people may not want to invest that long, and the issuers may not want to borrow for that long. So the maturity will be based on the need of the issuer and the need of the investors. But the maturity is the date at which the payment is on the bond is made. Once the face value is paid, the bond dies, it ceases to exist, it becomes null void, and so on and so forth. So what's a coupon? Now, a coupon is not an interest rate. Now notice, on a bond, there is no mention of an interest rate. There is no such thing. Basically, how much you are willing to pay for this will determine how much money you're going to make on this investment. But sometimes there will be a coupon on this bond just to sweeten the deal. So for instance, on top of this promise, the issuer will pay $1.50 every 6 months to the holder of this bond. There you go. That's your coupon. It used to be that a bond had detachable stamp-like coupons, and each one had this $50 or whatever the coupon was written on it, and that's why it was referred to as coupon. Some countries actually refer to it as a stamp, and people used to detach them and take it to the issuer and get their periodic payment. Now, this is a payment that's not an interest. It really is just to sweeten the deal and to motivate people to buy or invest in this specific bond. Obviously, it becomes part of your yield, part of your earnings. However, the notion of bond having an interest payment is not correct. So what is a bond interest rate? Bond does not have an interest rate. It may have a coupon payment, which some people may refer to as, say, 5% coupon. That usually refers to 5% of the face. So in which case, 5% of the $1,000 will be $50. However, this is not an interest rate. This is a coupon rate. Bonds don't have interest rates in most part. So the issue is, a lot of the times when people refer to what's the interest rate on the bond is actually not a correct reference to the earnings on the bond. So what is a bond yield? Bond yield is how much money do you earn by holding this bond. So let's calculate this one. Let's say that current price, you decide. Now, notice the bond will not have a current price on it. It just, this is it. This is the entire bond. You will pay whatever you can to purchase this, and whatever you want to purchase this. Now, if you're paying too little, you may not be able to buy this. And if you're paying too much, then, well, you will feel pretty bad about buying something that you could have otherwise bought cheaper. So let's say that you actually paid $900. That becomes the current price of the bond. Now, the coupon, well, we said that issuer will pay $50 every 6 months. So you're going to receive a $100 coupon. And then you're going to receive a face value of $1,000 at the end. Now, I'm just going to do a very rough return or yield calculation. I'm even going to ignore the time value of money. You have that in your textbook. You have that in your previous classes and this class and so on and so forth. So this is going to be really, really rough just for illustration purposes only. So let's go back to a spreadsheet. So current price, let's pay $900. Coupon, we're going to receive $100. And then the face, we're going to receive $1,000. Now, notice, this is what we're receiving, $1,000. And we're receiving a coupon. Again, a rough calculation will be the face plus the coupon is what we're going to get. That's $1,100. We are paying $900 for this. So our net earnings will be your $1,100 minus how much you paid for this, and that's $200. Now, your net return or net yield will be then 200 divided by the 900, which is approximately 22%. Now, again, this is really rough. This is not how you precisely calculate the yield. However, to give you the idea of what is yield and how it is different than return or interest, how it is different than interest, just for illustration purposes, I did ignore all time value of money. So having said that, if you're going to receive $1,000 face and $100 coupon, all our future cash flow will be $1,100. We're going to receive $1,100. We have paid $900 as of today, which we decided to pay that. We could have paid less, but then we wouldn't be able to buy the bond. If we paid too much, then maybe we paid too much. Now, the net earnings is $200. That's the difference between how much we're going to receive and how much we paid. And notice that we have net earnings of $200. Now, the net yield then is how much we earned, $200, divided by how much we invested, how much we paid to purchase this bond, and that is 22%. Now, we will talk about this in later lectures. However, the yield and the price is inversely related, meaning if you pay too much, say you paid $950, notice how the yield is going to change. So by paying more, your net earnings will go down to 150, and therefore your net yield is going to go down. So let's say that you paid $980. Notice how both of them are going to change. You make 120, and your net yield is down. So when interest rates go down, that actually means that the prices of bonds will go up, because the only way that you can actually earn more is by paying less, and the only way to earn less is by paying more. So the net yield and the price of the bond will be inversely related. So what is bond indentures? Well, when you issue a bond, you are basically borrowing from somebody, and you have to make certain promises to that person or to that institution what you're going to do with the bond. Not every bond has indentures, but When they do, they are to define how the bond proceeds will be used, what are some stipulations about the actual bond issue, if there are any collaterals, if there are any co-signers, if there are any sort of stipulations as to the issue of the bond. So these are the preliminary topics in bonds, and we'll talk about more questions in other parts of this lecture.